Good afternoon, everyone. Seeing everyone trickle in here, I'll just give it a couple seconds before we officially start. Welcome to our webinar. Happy to have you. All right, so I'll start making our formal introductions here. My name is Cassie Hopkins, and I help manage and coordinate the webinars for Houseman Group. We're excited to have you here for this webinar. It's one of the first times we've ever done like a 101 how-to compliance, and we've got the best in the business here with us with Sarah Borders from Compliance Benefits Solutions. I'm going to go over a couple housekeeping things before we get officially started and into all of the content. So the first thing I'd like to remind everyone is that this webinar is recorded, which means that you can share it with people, or you can also return to it after the webinar is over. If you want to review anything, you will receive an email with a link to the recording, as well as a copy of the presentation slides if you want to use those to follow along. You also can ask Sarah any questions during the webinar. We have the chat feature for that, or you can also use the formal question button on Zoom. We're going to save all those questions for the end, just in case Sarah ends up answering your question during the presentation. So if you have anything you'd like to ask her, you can just type it into the chat and we will get to it at the end of the presentation. Finally, we'll have a survey at the end of the webinar. We'd love to hear what you thought. We'd love to hear if this was your first webinar, or if you have more compliance questions, or if you're looking for different topics. We just love hearing feedback because it makes our webinars so much better for you guys. So without further ado, I will give our introduction to the wonderful, intelligent Sarah Borders. Sarah is an industry leader in providing guidance on legislative and regulatory topics such as ERISA, ACA, Section 125, COBRA, HIPAA, Medicare, and tax-advantaged accounts. In her previous roles as Vice President of Benefits Compliance with NFP and Director of Compliance with a regional benefits firm, she's served hundreds of employers' compliance needs, from identification to resolution. She's written dozens of articles on regulations, and she frequently presents on compliance topics, such as she is doing right now. She is an active board member on the Austin Association of Health Underwriters, and she is a member of the NAHU Legislative Council Employer Working Group. Her designations include an active license with the Texas Department of Insurance, CEBS, or Certified Employee Benefits Specialist. She's also a certified healthcare reform professional, an ACA certification in healthcare service associated, and she holds her MBA from Texas A&M Corpus Christi with a BA from the University of Incarnate Word Corpus Christi. Thanks so much, Sarah, for being here. We always love to have you.
Thank you, Cassie, and welcome everyone. I'm sure that I've met a lot of you on this call today, maybe even in person. I was in Madison and Pewaukee very recently, and that was really fun to get to meet a lot of clients in person, up close and personal, for a compliance review. So what we're going to do today is kind of take a few steps back and do a little bit of benefits compliance 101, some basics for those of you who are employers or even benefits professionals, as a refresher. So what we're going to look at is kind of some main areas of federal benefits compliance and where these particular rules come from. A lot of times I think it's helpful to know where something originated from, what is the purpose of it, when was it passed, is it new, is it old, and what is sort of the spirit of the rule? Why did Congress enact this rule in the first place, basically? And I think that can help you understand why it's important that you take a look at being in compliance with this particular rule and how you can keep yourselves out of trouble. We're always here as a resource, and we want to support employers as we help to strategize in the health plan. With it comes compliance responsibilities that you all have on your plate, whether you know it or not. But we want to be able to support you, educate you, and to help you rather than just sort of inform you. We're also going to take a look at the main governing bodies, the three agencies that you typically see write regulations that pertain to employee benefits plans. Also, we'll talk about some penalties and give you a few takeaways that you can use just as a value today for attending this presentation. So I think it's important to understand how compliance can actually benefit us and maybe where your role is and where the role of your broker is. So first of all, what are some benefits for being in compliance at all? I mean, I think we typically see compliance as having no benefits at all, but actually there are some benefits, and I think we can kind of turn, the burden of compliance, maybe we can see it a little bit different way and maybe more of a positive light. And I just wanted to outline a couple of those benefits so that you can maybe reframe how you think about it. First of all, the benefits for employees. It ensures that the benefits are received as promised. So nobody likes ambiguity and nobody likes to be surprised. And if we have something in writing and clearly communicated, that is a benefit to everybody involved. We want to have clear communication, clear expectations, and something to point to should there be a question and any sort of dispute where you have something in writing that everybody can be just super clear on. That helps. There's nothing wrong with that at all. So I think that first and foremost is making sure that the benefits are received as promised, and that's done in a couple of ways. It also protects against discrimination and unfair treatment, which is something that HR departments are particularly interested in. And a lot of times that's why they even got into the HR space, is because they wanted to help employees and they wanted to give them opportunities to advance and opportunities where maybe they didn't have in the past. So it helps against those things in many different ways. Discrimination can take many forms, and compliance can help sort of mitigate some of that that's inherent with offering group benefits. Also, a big perk of compliance is the ability to reduce taxes. We all want to reduce our tax burden, and that can be done through a number of ways: through pre-tax premium payments and contributions, exclusions from gross income for the employer, and insurer payments. And it also helps employees to understand what it is they're actually getting and how much of a benefit it actually is to them when they come on board with you and they are allowed to participate in the benefits that you offer and that you spend so much time and investment on. You want to make sure that they know the value of those benefits through the compliant manner. Also, we have benefits for employers. There is a large tax savings for employers specifically. Yes, for the employees, but also in the form of employment taxes and business deductions. It also protects employers from their fiduciary liability by being in compliance. And it helps employees to want to come work for your company. You can improve your attraction and retention of your employment practices. And also, I just wanted to mention the role of a benefits, sales or service professional, those who are really tasked with helping you to strategize your employee benefit plans, to service your plans, to speak to your employees, to help you with just the countless things that an advisor agent helps you with. So they help with employees understanding of their benefits themselves, and they also help the employers to understand how they're supposed to comply with these regulations. So ultimately, compliance is an employer responsibility, a fiduciary responsibility of an employer, and it is not necessarily the legal responsibility of a broker. And so I think the broker's position in all of this is to educate, to support, to provide solutions and direction, but ultimately it is absolutely the requirement of the employer to make sure that they are in compliance. You cannot sort of pass this off and just indemnify yourself by working with one broker or another. It ultimately is your responsibility, and it's good though to have the support and the education that you need, rather than you kind of assuming that everybody's doing something for you, but it's not happening. Also, the broker needs to provide tools and assistance to comply. This is something that we at Hausman Group focus on, as a main priority, and we do this day in and day out. It is part of the fabric of everybody on the team, that compliance comes, first and foremost, putting together a plan design, but also making sure that it's compliant and making sure employers are given the solutions and the support they need. It also helps. Also, the goal and the role of a broker is to help the clients educate their own employees, and also just to showcase the value of what an advisor does for you, because they are not all cut from the same cloth. And some, frankly, have no interest in compliance. Others have a little bit more, but we really take the stance that this is so important that we need to make it one of the first priorities in making sure that our employer groups are in compliance. So here's sort of an overview of the federal laws that pertain to employers when they sponsor group health insurance and all the other benefits that you provide, such as dental, vision, life, disability, flexible spending accounts, HSAs, all of those sort of products kind of fall under these various laws. So the main ones, the ones on the left that impact employee benefit plans are ERISA, COBRA, HIPAA, the ACA or Affordable Care Act, the rules in the Internal Revenue Code or the tax code, the CAA, and transparency and coverage rules. So those are the main federal laws that you see come up again and again and again with respect to providing a group health plan. There are also other laws that pertain to benefits, and they come in sort of by way of employment laws generally that kind of sometimes pull in benefit offerings, such as FMLA, the ADA, GINA, mental health parity rules, USERRA, and Medicare secondary payer rules or MSP rules. So a lot of acronyms, but I'm going to break this down for you all, especially with regard to the main laws that impact group health plan benefits. First and foremost, the main rule that applies to almost everything that we do day in and day out, and the one that you need to know the most about, is ERISA. ERISA stands for the Employee Retirement Income Security Act of 1974. So it is older than I am. It is not a new law, not at all. It has been revised, so to speak, over the years. There have been things added to it, and a lot of case law has come from this rule itself. But basically, the purpose of ERISA is to inform plan participants of plan benefits and rights. It's designed to protect promised benefits or vested benefits for those plan participants, those who are actually eligible and enrolled in the coverage, and that can include retirees and COBRA participants. And it provides federal government with information on retirement plans and group health plans, mainly in the form of a 5500 health and welfare filing. And there's a similar filing in 5500 for retirement plans as well. So under ERISA, there are some key requirements, and some of these might sound familiar to you all, especially if you've done a compliance checkup with us. So first and foremost, under ERISA, employers are required to have a written plan document, an ERISA written plan document, and a summarized version of it called an SPD, a summary plan description. It also, in many cases, requires a summary of material modification, which allows employees to know when something is changed in their group health plan, and it gives them steps, or gives the employer steps to provide notice of these changes and what changed and when it was effective. Also, for most plans, most larger plans that are subject to ERISA, they also have the requirement to file a Form 5500 with the Department of Labor. So a Form 5500 filing is not a tax filing, it's not a monetary filing, it is an information filing that is due to the Department of Labor, usually annually, depending on the size of your plan, meaning how many participants are enrolled in the plan. Also, when a plan is subject to ERISA, there are many fiduciary obligations which can be imposed on those who are acting like fiduciaries, those who are responsible for decisions that are made about the plan, those who are responsible for claims decisions about the plan, like what strategy are we going with, which carrier are we going with, what is the employee contribution going to be? So that typically is going to be someone who's like an officer of the company, CFO, usually head of HR, would be in that fiduciary capacity, and they have the obligation to operate the plan in a certain manner, the use of plan assets, making sure that the coverage isn't, the value of the coverage, the expense of the plan doesn't meet the actual outcomes that we're trying to achieve. So in other words, why are we paying so much for the value that we're getting? Those kind of things need to be scrutinized by those who are considered fiduciaries. So again, the most important thing on this list, I think, aside from fiduciary obligations, is to have those written plan document and SPD. And so sometimes you see this called a wrap document. And this can be an instrument that we use to supplement the carrier certificates of coverage that are not going to be considered a fully compliant plan document. At least under ERISA, it's not sufficient. So we put in place this thing called a wrap document, or a wrap SPD, sometimes called an ERISA wrap, that will supplement the required ERISA language that's not going to be found in your carrier booklets. And so if you're not sure if you have this type of document, or you're concerned, maybe you're not really sure if you have this, because this would be the first thing that the Department of Labor would request in the course of an investigation. If you don't have one of these, please reach out to us, because we need to have a conversation, because this is first and foremost required, regardless of size. And then, of course, there's some other cursory requirements that are imposed on those employers who are subject to ERISA. So again, ERISA's purpose is really to make sure that people get their benefits as promised, and that certain information is given to the federal government if there is a 5,500 filing requirement that is due. And so the next major area of compliance that you hear about again and again is the ACA, healthcare reform, the Affordable Care Act, originally called PPACA, the Patient Protection and Affordable Care Act. So I think since then we've just shortened it to ACA. So the purpose of the ACA is to get every US citizen covered under a health insurance plan. So if you're newer to benefits, or maybe you weren't really in this industry back in the late 2000s, 2009, 2010, when this was passed, this was a problem. It still is, frankly, but the goal of the ACA was to try to get every US citizen enrolled in a health insurance plan, whether it was through their employer or whether it was through the exchange. That's why they set them up, or some other means. And so that's why I think you see a lot of strict reforms. Was the whole goal of getting every individual, whether they're employed or not, covered under some kind of medical plan. So what does this mean for employers? Employers must offer affordable coverage to all full-time employees, or they have to pay a tax. And that can be penalty A or B for failure to offer that coverage. Also, individuals originally were supposed to have coverage, or they were supposed to pay a tax. However, that was zeroed out based on some legal windings through the courts, windings through the Congress. It's definitely taken a hit, but they were able to get that tax zeroed out. So really, there technically still is a tax, it's just $0. It also was put in place to establish the health insurance exchanges to try to make access to health coverage easier for all individuals. States could develop their own exchanges, many of them did, or they could default to the federal marketplace, which is known as healthcare.gov these days. So many states do still have their own state exchanges, but some of them bailed out because it was too expensive, and they just went through the federal option. Since the passage of the ACA, I would say at the very first of when the exchanges came live, there were a lot of different choices available for consumers to pick for health insurance. There were ample carriers in a lot of the markets. Now it is very, very, very much scaled back because the carriers have been losing money. They don't want to necessarily just buy bad risk, and so they don't have to participate in the marketplaces. And so that has been, something that, sounded good, but I don't know if it necessarily worked. And we're back to the employers having to take most of the burden. It also was passed with the attempt to make coverage more affordable and more understandable. So this was done through a myriad of means. certain disclosures are required, certain coverage levels, affordability standards for employers, and also this piece about cost transparency, which has kind of rolled out in more recent years to try to make the cost of the medical care itself transparent so it can encourage consumerism. Whether or not that was achieved, I don't know, but it's up to interpretation, I suppose, but it's pretty expensive still. So ultimately, what does the ACA require? So this again is very high level, and we've done many trainings just on one or two of these specific areas, but overall at a high level, the ACA imposes on employers the requirement to offer affordable minimum value coverage to all your full-time employees and their dependents, to report to the IRS and to the individuals on the coverage that's offered by way of your 1095-C and 1095-B forms, to get rid of excessively long waiting periods. So none of you should have a medical plan that has a waiting period that is longer than 90 days. It requires that you provide certain notices, such as the notice of the exchange or marketplace notice, grandfathered plan notices for very few employers that are still grandfathered, and a summary of benefits and coverage, or we call it an SBC. It also requires plans to provide preventive services with zero cost sharing to employees, because there's a long list of preventive services that cannot have a cost share to them for any health plan. Also, there's a requirement to report the cost of coverage on the employee's W-2 under Box 12. If you have a self-insured or level-funded plan or an HRA, there is a payment called a PCORI fee that's due every July 31st. The offer of coverage to dependents cannot exceed, no dependents can be denied the ability to enroll in coverage if they're under age 26. And there can be no annual or lifetime limits imposed on what we call essential health benefits. So a lot of these are taken care of by your insurance carrier or your TPA, but some of them are squarely in the lap of the employer, such as reporting, how long your waiting period is, what's on your W-2, and making sure that your PCORI fees are paid. So a question came in, is the 90-day waiting period or less than 90-day waiting period for offering health benefits or for when coverage starts? So an employee from the day that they start can wait no longer than 90 days. So you can have a waiting period of first of the month following date of hire, first of the month following 30 days, or date of hire, or a straight 90 days, but they can't wait any longer from their date of hire past 90 days. They could start on their 90th day, and that means their coverage becomes effective prior to 90 days from when they started. So hopefully that answers your question. So the ACA did impose a lot of things on employers, and if you were in this benefits world back then, you know it. But maybe if you're newer in the past couple of years, this is not really any different. It used to be very different in how things operated, but now the ACA really did bring in compliance into focus. Before that, it was a little bit more loose and more focused on the retirement plan side, but it brought into focus ERISA and all of these other rules that I'm going to go through today. So the ACA was an absolute game changer in our industry, in the employee benefits industry, and it just had so many rules that were not in place before, and they're not going anywhere. So we've been with them for about 14 years now. And I don't think that Congress is going to be able to repeal that at this point, any piece of it. Now let's turn it over to COBRA. So COBRA has also been around for a long, long time. And what COBRA stands for is the Consolidated Omnibus Budget Reconciliation Act. And within one of these Omnibus Budget Reconciliation Act pieces of legislation, it was inclusive of allowing covered individuals to have the right to continue access under group health coverage following certain events. So this is why or how people are able to continue their group health plan benefits if they have a certain qualifying event. So termination of employment, reduction in hours, divorce, or death of an employee are the main four qualifying events that would cause somebody to lose coverage and then trigger the ability to continue that coverage under COBRA. So really, COBRA isn't a separate insurance plan. It's just the ability to stay on your plan at the full cost, adding 2% or allowing you to add 2% for administrative costs. So again, the purpose was to allow individuals to have the ability to continue coverage. There's also the ability to continue coverage under state continuation in many states, but COBRA is the main federal law that allows this. So for employers, what does this require that you do? So first and foremost, it requires you to send out a COBRA initial notice. When someone is first enrolled in the coverage, there needs to be a COBRA initial notice mailed to them and their enrolled spouse within 90 days of enrollment. This is sometimes missed, and we've spoken to many of you, probably with Hausman Group, over 100 employers, we've had this conversation. We've done many trainings on this. So if you're not sure if your COBRA initial notice is being mailed, you want to either check with your COBRA vendor, check with your Hausman Group rep, or make sure that you start doing it. You start mailing it, not just giving it to employees in a packet or an email or a new hire guide. No, we want to mail the COBRA initial notice. Similarly, we want to mail the COBRA election paperwork. So this is when someone actually has one of these events, termination of employment or reduction in hours is the most common. We want to send them a COBRA election notice when they have one of these events that allows them to elect COBRA. That's the one everybody seems to be doing right, but we want to mail both notices, initial and election notices, via first class mail to the enrolled employee and any enrolled spouse, because the spouse has separate and independent COBRA rights apart from the employee. Also, you have to determine the COBRA premiums. This is a function typically of the employer with assistance from a TPA, a carrier, which really for a fully insured plan, that would be just the full cost of the coverage. But if you're self-funded, you'd have to get the COBRA rates from the TPA, or you have to hire an actuary. And also there needs to be in place a process for managing COBRA. This is not something that you can just forget about. COBRA is highly litigious. People can just call and complain to the EBSA, to the Department of Labor, when they feel like they were not provided COBRA timely, and they do. And so you want to have your notices buttoned up. So it's very, very important that you're clear on COBRA. Use a vendor, absolutely, but don't just go on default and never think about it again, because you do ultimately have the requirement to comply with COBRA, even if you outsource the heavy lifting and the record keeping. Question came in, if they do not elect or take coverage, is this still required? So I think what you're asking is if they do not elect medical insurance, dental insurance, and vision insurance, also FSA or HRA, if they elect none of those, maybe they're just enrolled in the life insurance or disability, then you don't have to send a COBRA initial notice. So yes, that is true. I think that's what you're asking. But for example, if they just took vision and they have a spouse, it's employee and spouse just on vision, then they would need to send a COBRA initial notice, or you would need to send a COBRA initial notice, because they can elect COBRA for vision only if they have a qualifying event. So, okay. You're welcome. Thank you. Okay. So COBRA is really important. It gets missed a lot of times. It's downgraded and it needs to be upgraded to the priority list. It's one of the things that's easiest to fix. And if there is a COBRA fire, it's really hard to fix. So fix it proactively. Get your COBRA notices out at the correct times. Keep great records, or hire a great COBRA vendor. We have a lot of suggestions there. Okay, moving on to our other main federal rule that I mentioned before, HIPAA. So HIPAA stands for Health Insurance Portability and Accountability Act of 1996. So this was passed obviously in the 90s, and there was a lot to HIPAA, a lot that was included in here. The main purpose of it is first and foremost portability, which allows special enrollment rights upon certain life events. So when an employee experiences a loss of group coverage, marriage, birth, adoption, placement for adoption, it allows them to come onto the plan in the middle of the plan year if they didn't elect it prior, like during open enrollment. Also, it prohibits discrimination based on a health status. So PEC, otherwise known as I've just forgotten it, just flew out of my brain. I'll remember it in just a moment. But it prohibits the imposition of maybe saying you can't be eligible if you had cancer, or you're not allowed to enroll in our plan because you're pregnant. You know, just those kind of things would have happened prior to HIPAA. And so under HIPAA, that's not permissible. There's no eligibility criteria that you can impose based on a health status itself. Pre-existing conditions, excuse me, it just went out of my mind. So there also are some stringent rules by way of HIPAA imposed on wellness programs. So if you have a tobacco surcharge, if you're imposing some kind of surcharge or reward, either way, kind of a carrot or stick on somebody's health status, or maybe their cholesterol level, their BMI, their blood pressure, their cholesterol levels, and there's some sort of surcharge that's imposed because those levels are not where they should be, that brings in these stringent HIPAA wellness program rules, and you'll want to reach out to us. Also, the other side of HIPAA is privacy and security. So this is probably more what you think about when you think about HIPAA, and that's protection of personal or protected health information, or we call PHI. It also requires the development of privacy procedures and security procedures, and requires a couple of other things such as a risk assessment, training, the defining of somebody who's going to be the security and privacy officer. And so most employers who have a self-funded plan are going to be subject to HIPAA privacy and security. So employers, what are you supposed to do under HIPAA? What does that impose on you? It requires that you provide a special enrollment rights notice, sometimes called a HIPAA special enrollment rights notice. If you're a Hausman Group client, this is something they help you with. Conducting a risk assessment, developing privacy and security policies and procedures, providing notices of these procedures, making sure that you have your business associate agreements with your vendors all squared away and signed, and breach notification procedures if there should be a breach. So HIPAA is not merely just a HIPAA privacy practices policy or notice, it is all of the above. So HIPAA is quite extensive, and I would say most employers struggle with this, but if you are struggling with this, please reach out and we can help you with that, especially if you're self-funded. The other main thing that I want to make sure we talk about is how the code, the tax code, is imposed on employer group health plan benefits. And it creeps up in a myriad of ways, but also I think in a good way, because it allows sheltering of taxes. And so if you think about that, if there were not these rules, these cafeteria plan rules, you probably heard that term cafeteria plan, or section 125, that just refers to the section in the IRS code where these rules are found, kind of like 401k, that's found in the code. This is from 125 in the code. And they call it cafeteria plans throughout the rules and regulations. And what this is designed to do is to allow premium payment on a pre-tax basis via salary reduction. So as it says in its name, it allows the employees to overall reduce their taxable wages, their taxable amount that they have to pay taxes on, by way of a salary reduction through this 125 plan. So what does that look like? It can be health FSA contributions if you have a health FSA, dependent care contributions, where they set aside funds for daycare expenses, or employer flex credits, where you're giving a certain amount to the employees to use for benefits, and those are not taxable to them, and that reduces their salary even further. So when an employer allows salary reductions to pay for these medical benefits, dental, vision included, HSA contributions, all of that included here, it requires a couple of things. First of all, a written plan document that sometimes we call a POP, POP, or premium only plan. Sometimes you'll hear it called a 125 plan, a cafeteria plan, premium conversion plan. It's all the same thing for this document that's required anytime an employer allows employees to pay pre-tax for their benefits. Also, what it includes, and this is where this comes from, is these irrevocable elections, meaning they can't change their election that they make during either their new hire enrollment or open enrollment selections unless they have a qualifying life event. So this is where this all comes from, because they did not want employees to come in and out of the plan as they want, only taking coverage when they need it and dropping it when they don't. So this protects your plan, but it also is required under the code. So you can't allow employees to just come in and out of the plan, which I think most employers know that there's 125 life events that you have to recognize. It also imposes non-discrimination rules. And what these non-discrimination rules are saying is that your benefits or your contributions can't favor those who are considered highly compensated individuals. Now, if you have a health FSA, there are even some more strict rules about how those are to operate. First of all, for health FSAs, they have to use all of their election funds before the end of the plan year, unless you have a grace period or a carryover provision. So it's this use or lose it rule, where if they don't spend all the money in their FSA, then it reverts back to the employer and you cannot give it back to them even as taxable income. It also imposes contribution limits. So at this point, I think it's $3,250 for the most that an employee can elect to set aside pre-tax for payment of medical expenses throughout the plan year under an FSA. A little bit different for HSAs and so forth, but basically anytime there's a pre-tax contribution or payment, these rules apply, and the employers need to have a cafeteria plan. They need to run non-discrimination testing unless there's an exception. And if you have a health FSA, there's some more rules that you need to recognize, such as use or lose it and contribution limits and irrevocable elections as well. They can't change the funds or the election in the middle of the plan year if they just decide to without a qualifying life event. Okay, under the code, we also have some more tax advantaged accounts that get pulled in. The other types of accounts, aside from FSAs, are health savings accounts and HRAs. So health reimbursement arrangements and other employer reimbursements are pulled into the code, and they have tax advantage status as well. So the employer pays an HRA benefit, meaning they reimburse. There are no employee contributions in HRAs. It's only an employer provided benefit that reimburses them for some medical expense, whether it's for the deductible, co-pays, out-of-pocket maximums, just depends on how that HRA is set up. There's no income to the employee in that situation. So those funds that are reimbursed are not counted as income. So that's a definite benefit to the employee. When you offer an HRA or some sort of reimbursement arrangement like this, there is a written plan document requirement itself. There is substantiation that needs to be made as far as, is this benefit a reimbursable expense? Is it tax-free reimbursable expense under 213D? The same rules that apply to FSAs. And there's also another non-discrimination test that needs to be run. A lot of employers have HRAs and they don't know these things, but it is by itself a group health plan and it has its own requirements. So you'll want to make sure that you're complying with those. Also, if you offer maybe an HSA, HSAs are quite different. They are individual bank accounts for singular taxpayers. They're not like employer-sponsored accounts like FSAs would be. So they are set up usually by the employee. They make pre-tax contributions. Sometimes the employer will match or provide some seed money. And that also allows them to make a tax-free contribution and distribution for medical expenses allowed under that same list of Code 213D expenses. The employer requirements require that they satisfy Section 125 non-discrimination testing because, again, we've got pre-tax payments coming out of there. So that's why it pulls in health savings account contributions. So sometimes employers don't know to include those in their non-discrimination testing. Okay. So again, we have FSAs, dependent care FSAs, HRAs, and HSAs that all fall under the code, the IRS code, and we want to make sure that those are running properly, because I don't know about you all, but the IRS, I don't want to mess with the IRS under any circumstances. We want to make sure that things are carefully looked at and complied with. Moving on to the last really big area of federal benefits compliance that pertains to employee benefit plans would be the CAA, stands for Consolidated Appropriations Act of 2021, and TIC stands for Transparency and Coverage Final Rules that were issued right before it in 2020. So these rules kind of go together because they have very similar purposes. The purpose of both of these rules is protection for employees related to surprise billing and transparency in healthcare. So exposing the cost of what healthcare actually costs, because we don't know. It's still really difficult to find out how much something costs, because you get the service and then you're billed later, and then you just have to deal with it. You have to try to negotiate. So under the CAA and transparency rules, what did this require of employers? It required a lot of things, and it was probably the most significant piece of healthcare legislation since the ACA was passed. So luckily enough, the carriers and TPAs do assist in large part with a lot of these requirements, kind of like the ACA, but that doesn't mean that you don't have to think about this. So a couple of things that requires employers to do: mental health parity, NQTL comparative analysis. So NQTL stands for non-quantitative treatment limitation comparison analysis. So this is sort of an analysis that would typically be at least somewhat done by a TPA or a carrier. TPA stands for third-party administrator, like a medical claims TPA. And the employer is going to need to lean heavily on their service providers to provide this. Prohibition on gag clauses and attestations that we deal with later on in the year. Compensation disclosures that you would receive from Hausman Group if they are working with you currently. Advanced EOBs, certain things on ID cards, provider directories, and a searchable internet tool also would have to be facilitated by a carrier or third-party claims payer. Surprise billing protections, you probably heard of those, where they can't just bill people for certain types of expenses. If they're out of network, there has to be sort of a dispute resolution process between the provider and the carrier or the health plan itself. Machine readable files have to be accessible on a public facing internet searchable tool. Air ambulance data is going to have to be submitted through reporting procedures that have yet to be finalized yet. We still don't have final rules on that. And then lastly, we have RX and healthcare spending, otherwise known as RxDC, that is also being taken care of primarily by carriers and medical claims payers. All of these came as a gift from the CAA. And again, the purpose of it is for employers to be able to, well, employees themselves to be free from, for the most part, surprise billing, and also transparency in the healthcare spend itself to try to encourage consumerism. So the enforcement agencies and some penalty amounts. Everybody wants to know about penalty amounts. And so the three main bodies that write all these regulations, and you'll oftentimes see them write regulations together, and you'll see it referred to the departments issued final rules. These are the departments. So these are the regulatory bodies in Washington, D.C. that are tasked with writing regulations that come from what Congress passes as part of legislation. So legislation, if you read it, it's usually a somewhat vague and a little bit more like general information, and then they task the departments with writing how to comply, and FAQ. So that can come in a lot of forms. Regulations come in FAQs, they come in formalized final rules, they can come in just like informal comments. Like there's all kinds of ways that regulations come out that we have to pay attention to. So if you get newsletters from us and it talks about the departments, that's them. These are the people that write the rules. Now, the big one is the Department of Labor. they are the primary enforcement body of group health plan compliance. So the division that is tasked with ERISA compliance for health and welfare plans would be EBSA, Employee Benefits Security Agency Administration. So they're a subdivision of the DOL directed by the Assistant Secretary of Labor. There are, at this point, 400 plus investigators and auditors. And we have some numbers. These are, it takes a little bit of time to get these numbers because they report them the year after. But in fiscal year 2022, EBSA recovered 1.4 billion with a B for plans and participants. And this includes retirement plans as well for failures, but it includes retirement plans and health and welfare plans. So compliance is really important because they can recover funds in many different ways. They can have, corrective action plans. They can make claims be reprocessed. They can impose fines and penalties. They can sue in courts. There's a lot of enforcement mechanisms that they have. They have authority over ERISA, COBRA, HIPAA, the ACA, and mental health parity rules. That's the primary areas that they have enforcement over. So their reach is quite extensive and wide-reaching. They have the authority to enter a company, inspect books and records, ask questions, request documents, and they have the right to request documents from all service providers, subpoena documents, forms, notices, and communications, compel testimony of witnesses, investigate crimes. If there's some other crime that they find, they can refer it to the IRS, for example, and assess penalties and bring civil action. So it is never something to play with, to think, oh, we're okay. You always have to be watching these things because, again, you're fiduciary. This, whether you knew it or not, fiduciaries are required to be in compliance with group health plan laws. And so the Internal Revenue Service, they have probably more power than even the Department of Labor. They are the IRS, and their reach is vast, as we all know. So many employer provisions that are incorporated into the code would include the employer mandate provisions because they have a direct tax that's tied to them. ACA reporting itself has to be submitted to the IRS. Non-filer penalties, if you were supposed to file and you didn't, or you filed late, that brings in the IRS. PCORI fees, PCORI, that is implied a payment to the IRS. They can impose excise taxes for late filings or non-payment filings. Taxation and non-discrimination under the IRS. Cafeteria plan rules, FSAs, HRAs, and HSA rules all fall under the purview of the IRS. And so, again, not to be scary or to make you feel bad or anything, but these are serious rules that we have to deal with. It's neither here nor there. It's just part of it. It's part of a company's obligations under many rules. And we can either sort of, I guess, wring our hands and just get overwhelmed with it, or set processes in place to be in as compliance as much as possible. And then we have CMS, Centers for Medicaid and Medicare and Medicaid Services. And they are the primary federal enforcement authority of the Public Health Service Act, which sometimes for non-ERISA plans, they get brought in by the Public Health Service Act, and HIPAA. So you'll see a lot of regulations on HIPAA coming from CMS or the Office of Civil Rights, OCR, which is a division of them. They have oversight of Medicaid, Medicare, CHIP, and the marketplace or healthcare.gov. OCR manages complaints related to HIPAA privacy and security. And they are also tasked with a lot of parts of the CAA, with RxDC, the gag clause prohibition, compliance attestation, air ambulance reporting to be due sometime, and the No Surprises Act. So a lot of this is going to be assisted with the assistance of your carrier or TPA, but this is who is tasked with enforcement of mostly like health plan, the offerings of coverage, the HIPAA portion of it. You see CMS brought in for like what needs to be offered, how it needs to be offered, is it discriminatory? Those kinds of things tend to be under the purview of CMS. checking my Q&A here. So there's a question here about, is HSA non-discrimination testing, is that only required if the employer put money in? No. Non-discrimination testing is required for any pre-tax payments unless they have what we would call a POP safe harbor, where they're really just allowing employees to pay for benefits pre-tax. And employees can make contributions to their HSA, but ultimately, technically, HSA contributions made by the employee, even if the employer doesn't contribute, would need to be included in the cafeteria plan 125 non-discrimination testing itself. Hopefully that helps. Okay, so compliance penalties. So these numbers change year over year, but these are about the amounts. They change a little bit, couple dollars here and there based on cost of living. So under ERISA, what are some of the penalties here? So failure to provide a copy of the written plan document, or SPD, can result in $110 per day. Pretty severe penalty. It's a good idea to have a plan document, in other words. Form 5500 is a severe penalty if there's a late filing. It can be up to $1,100 per day per late filing. So this is a significant penalty. So all employers that should be filing a Form 5500, unless you're small enough to not have to file, should be making sure that this is done on time. And it can also have criminal penalties if they feel like there was like some sort of criminal activity or gross negligence. They can refer that for criminal penalties. PPACA or ACA. In general, there are some areas of the ACA that can be defined or be fined up to $100 per day, depending on the particular provision. But depending on what it is, it could be higher than that. HIPAA, in general, per violation, $100 to $50,000 per violation. And I have seen enforcement of this. And criminal referrals of up to $250,000 and up to 10 years in imprisonment. All of this can be subject to civil lawsuits, and sometimes you do see that. And the tax code, of course, they can impose tax penalties, which just come in the mail. They can include interest on those penalties. And that's usually what you see is, as far as enforcement goes, from my perspective, usually where you see penalties assessed are through the IRS imposing penalties for failure to file ACA forms, failure to file 5500s, filing late, employer mandate penalties because your coverage isn't affordable or doesn't meet minimum value, or your filing's done incorrectly. And sometimes I also see penalties imposed for failures with Medicare secondary payer rules. So they feel like your health plan should have paid a certain claim, but Medicare did for whatever reason. Sometimes they'll send letters asking you to pay it or to provide documentation. So that's a lot of the times where I see enforcement. Oh, and PCORI fees as well. For late PCORI fee payments, you'll see a lot of times excise tax imposed for late filings, or maybe they even want to do an audit to see if you actually paid it, and they'll ask for documentation. So most of the time, what I see is IRS related penalties, because they have just the ability to send out penalties and ask you for documents. So IRS is probably the one to watch the most closely. So some key takeaways: you want to educate yourselves on how to identify compliance problems. How do you do that? Well, first and foremost, you want to make sure that you are using Hausman Group to assist you in managing new and ongoing compliance obligations. We just have so much information that we send out, reminders, newsletters, these types of webinars, the ability to do a compliance check in some instances. You just want to take advantage of these things because you will have a very hard time going it alone. And so we want to be able to provide you that support and education. If you're working with us now or not currently working with us, you want to come, consider working with us, because we take this as a main priority, and everybody on the team is highly competent and educated in these areas. Also, you want to put a process in place to spot compliance issues. So making good use of your vendors, making sure that they're reminding you of things. making sure that you have oversight in place, making sure that you have RFPs sent out every year so that you can examine claims costs and provider administrative costs, making sure you're doing your non-discrimination testing, that you have a plan document in place and that you've read it, you've reviewed it. All of those types of things are things you want to have in place as a process. Pay attention to reminders and due dates because we're sending them out all year round in your calendar. Be clear, be real with yourself that you might be, if you're on this call today, you may in fact be a fiduciary and could be personally liable for failure to comply with some of these requirements. Again, I don't want to scare anybody or make anyone nervous, but you know, it's the seriousness of what it is that you're doing in your role, because there's a lot on the line. There's people's benefits to be paid. There's a lot of money and investment on the line. And so it does matter. Also, just remember that benefits, you know, firms, your advisor, your agent can assist and provide resources, reminders, reviews, but ultimately, even if you use a COBRA vendor, even if you use a particular enrollment vendor, ultimately the employer holds the liability. And so I want you to think about is just kind of using here. And if you have any questions, we're getting to the end of the presentation. So please put them into the chat. But ultimately think about it this way. If I am leasing an apartment, I am able to sort of indemnify myself from a lot of responsibilities because I'm leasing it. A lot of it does go to the owner or the property manager or whoever. But when I am owning a house, when I own that house, then I am ultimately responsible. Now I can hire all kinds of experts to help me kind of contract out certain things, but ultimately, if there's a problem, it comes back on me. If there's a problem with the government, it comes back on me as the homeowner. So I really want you to think about it that way, to encourage you and empower you to educate yourselves and to really take this on as a priority, that you're going to be in compliance for your company, because that's the role. That's what this role entails. So if there aren't any other questions, I haven't seen any others except for asking about the slides, and I'm sure they'll be available. I will turn it back over to Cassie, and I really appreciate you all going through this 101. Hopefully it was helpful for you.
Thanks so much, Sarah. Everything in there was so informational. I know I even learned a couple things that I thought I knew more about. So thank you so much for this great learning opportunity. I'll remind everyone, like I said at the beginning of the webinar, that the webinar was recorded, so you will be able to watch the recording again or share it with anyone that you'd like to. That'll get emailed to you. We also have a survey right at the end of the webinar. Once it ends, it'll pop up on your screen, and we'd love to hear some feedback from you on what you thought about today's webinar. And just again, just one more reminder, you will receive the slides and you will get a recording of the presentation. So thank you guys so much for joining. We're really happy to have Sarah with us. And thank you, Sarah, so much for presenting.
Thanks, everyone.
Have a great afternoon.